And we're going to ask ourselves, is the pullback that we've seen in the NASDAQ enough? Is it done?
Well, first of all, welcome back. I'm glad you're back because the market's rallying. While you were gone, the market didn't do nothing but correct.
So NASDAQ goes down 2 weeks in a row.
Right. It's good to have you back. I think it's getting close, in particular for technology. Semiconductors, obviously, with NVIDIA, with the analyst note today, is getting a nice, strong bounce-back recovery. But, over the last couple of weeks, I've heard from so many people that, yes, in fact, the rally can continue without the participation of mega caps and technologies. Unfortunately, statistically, that's not actually what's unfolded when you see names like Microsoft down 5% month to date, Apple down 7% month to date, and see the semiconductors down just as much. So it's good to have the return once again of semiconductors today. I certainly would not be selling expecting a more significant correction. Is there prudence in waiting for what the earnings are going to be for NVIDIA? Yeah, I think so. I think if you have a position, you kind of sit with it, you wait to hear what's going to go on. But we've done a lot of damage, and the last point on all of that is just think of where price was when you left relative to the 200-day moving average. Price was 10.9% above the 200-day moving average. Now you're back. We've worked off 3%. It's only 7.9% above the 200-day, and it's very close to shaking the hand of the 50-day moving average.
We'll talk more about NVIDIA in a moment, because I do have some questions about strategy as it relates to that very favored name. But Bespoke talks today about what Joe's talking about whether the overall rally needs tech and to what degree it does. Bespoke says wherever the U.S. equity market goes for the second half of August, a lot will likely depend on the direction of mega cap stocks. You agree with that?
I do, because it's such a big component of the S&P 500, right? I mean, tech and comm services is 35% of the S&P 500, so you need that participation. And that's why I think we have seen the markets kind of just be a little bit volatile and kind of in a trading range over the last couple of weeks because these stocks have all pulled back.
I know, but you guys made the argument, though, that you don't, like the other areas of the market are fully capable of picking up the slack. Jimmy's shaking his head.
Well, I think that's
as I'm talking about this. Like, you guys have made the case that you don't necessarily need tech. Now you're telling me you do.
Well, no. I've been saying, hold on a second. I think you can have some parts of the economy, the markets do better, and that could help the markets not totally collapse. But I do think you need some participation in tech overall. It's just too big, right? That being said, I don't think, I've been selling tech. And I don't think that we're done yet. Some of these stocks are still up quite a bit. The big 6, 7 are up anywhere from 30% to 191%, trading on an average of 34 times forward estimates.
Wait, you just said you don't think we're done yet in terms of selling on the mega names?
Yeah,
wow.
Because they're still expensive. They're up so much. They're definitely not in the value camp. And if you have rates continuing to rise, which we have been, especially after the CPI print last week, which didn't really show a lot of progress, some progress, but not a lot of progress. If rates continue to go up, I think that long-duration assets are going to struggle a little bit, and that does include tech. So I'm not saying there's a major collapse in the market. I think you're going to be volatile for the next month or two. Seasonally, that makes a lot of sense as well. And then I just look at some of these stocks and what they have done.
Well, I mean, I'm looking at the forward PEs of the stocks as we're filtering through the names here, right? Apple, which had a plus 30 forward PE, is now 28. NVIDIA, for example, which was at 62.5 in May, is now down to 46.5.
What are you getting at Apple in terms of total earnings growth and revenue growth? You had iPhones down 2%. Fine, I'll give you services. That was actually really the bright spot at 8%. That's only 25% of their business.
Yeah, I know, but
so 28 times for that kind of growth, Scott, is not attractive to me. And a lot of people are in this name. It's 7% of the S&P 500, and I just think people will take some profits.
Well, I'm thinking with Apple, though, are we judging it apples to apples, so to speak, because the refresh cycle, the new phone's going to come out in September. That's the quarter that matters more than anything if you're going to watch the iPhone metrics, right? Well,
maybe if the stock pulls back another 10%, I might take a look at it at that point, right? But I'm not doing it now because I don't think 28 times is really that attractive. The one name that I have been buying, it's not the big 7, is Fortinet. While you were away, the stock got clocked down 25% on that Friday when it reported. It is kind of making its way back, but this is a $280 billion total addressable market. They're gaining market share. They're growing revenues at 20%. Margins are expanding. So I can find places within tech, Scott, that I like. Big 6, 7, not so much.